Hello, my name is Sandy Hood and this is the ACCA and it's the financial reporting on the fundamentals level exam that I'm interested in. I'm looking at section C, and within it you typically get two large questions worth 20 marks each, and this one that we're going to look at is tackling a single entity question, an entity being a single business, not part of a group, and my ideas really on how to tackle these questions. There's been a lot to be benefited from in terms of exam technique in the past, and in those days when we were using pen and paper, then there were certain approaches that would earn more marks in the time that you had. Now I need to have a rethink, and this is my latest idea on how to tackle this sort of question to earn the 20 marks within the limited time that we have. Here's a question. Very kindly, BVP have put a couple of mocks on the ACCA global website, and I've taken this question from one of those mocks. It's available no charge so long as you use a special ACCA code, and I think it's very good for practice and preparation for this exam. Here we can see a question which is called Highwood, and this is typically the information that we would get on the exam. You can see basically a trial balance and a series of notes, and in this case on the top of the second column you've got the question, and underneath you've got the limited spreadsheet. It doesn't have all the facilities that Excel has, but I think it's useful enough, and certainly I'm going to advocate that you use that spreadsheet for all your workings. So using this mock, I think the first thing to do is to identify the task requirements, and then having identified those we'll move on to the next task, because that does involve changing the pages. So you know all the tasks and the data is identical for each. So this enables you to decide on the level of detail in your workings. If you know, as we do in this particular case, that we are producing the statement of profit or loss and the statement of financial position, then we've got 20 marks for those two together, and we can do the workings in order to be able to complete them. Here's the detail. We've got a trial balance. Fair enough. We've got equity shares. They're not $1 each, so we've just got to bear that in mind, that the number of shares is going to be double the value of those shares. We've got some retained earnings. Presumably this would relate to the 1st of May 2005, and then a convertible loan note. So immediately you can clock that in your head that we're going to have to do a way of isolating the debt component from the equity component. Some opening values. Interesting here, we can see property was bought quite a few years ago and includes within it a land element. So I'm expecting to see something to do with revaluation here. And some plants and equipment, accumulated depreciation, some current tax and deferred tax, both with notes. Inventory, notice that inventory's on the 4th of April, but our year end was on the 31st of March. So there's a note there. I suspect we're going to have to adjust that. Then we've got trade receivables, bank, trade payables, revenue, cost of sales. No doubt the cost of sales would have some changes within it, but we'll wait and see. Distribution costs and admin expenses. The first note says there's an 8% 30 million convertible loan note issued 31st of March. Okay, so that was issued at par. Just as a reminder that today is the 31st of March, so we are looking at something that's only just been issued. Interest is payable in arrears on 31st of March each year. The loan note redeemable at par on 31st of March 2019, or convertible into equity shares at the option of the loan note holders on the basis of 30 equity shares for each $100 of loan note. Interesting, because we've already looked at the question, so we know that there isn't an earnings per share calculation requirement within this question, but that would have been something I would have been looking out for if I'd seen that we've got a convertible loan note. Highwood's finance directors calculated that the issue of equivalent loan notes without conversion rights, it would have had to pay interest at 10%. So we're paying 8% because it's that much more attractive, because there's an opportunity of being able to make a capital gain perhaps if they are able to convert into shares. 2 columns, some discount factors, and fair enough, we can work out some sums, and I think that would be where I would want to start. I'm going to prepare a working, so I'm going to go straight into the spreadsheet, and in there goes my cash flows in each of the years. So we're paying out 8%, so 2,400, well, everything's in thousands, but 2,400 each year as interest, and then in the final year we pay out the 30,000 that we've borrowed. And we've got the discount rates, so we can quickly work out the present values. We've got the debt now. The debt is worth 28,476, and of course that's less than the cash received, so the difference is going to be the equity component, and that, I would say, probably in a written exam I would be putting that straight in, but I'm noting that, and then we will be putting both those figures into our statement of financial position when that arises. I'll note the debt and equity on paper rather than switch questions. That's the nature of what's going on in these exams, is that the first page within the software is the profit or loss, but the second page is the statement of financial position. So 2,400 can go straight into our profit and loss. Next note is that we've got some non-current assets. On the 1st of April a year ago, they decided for the first time to value the property at fair value. So we've got an adjustment, I would imagine. A qualified property valuer reported that the market value of the property on this date was 80 million, of which 30 million related to the land. At this date, the remaining estimated life was 20 years, and Highwood does not make a transfer to retained earnings in respect of excess depreciation, so that's one less thing to worry about. But deferred tax is provided on revaluations, so that is an additional task. Depreciation for the year has not yet been charged. Planson is depreciated at 20% per annum on a reducing balance method, and property depreciation should be charged to admin. Make a note. Normally we see these all going into cost of sales, but this time it's an admin expense, and plant depreciation is going to go into cost of sales. So quickly we jot down a little fixed asset note or a property, plant and equipment note. Here I've got the cost and valuation section at the top, and I've noted from the original trial balance that the value of the land was 25,000, and because the total value was 75,000, I was able to figure out that the buildings aspect must be the remaining 50,000. The revaluation, well, land isn't depreciated, so because it's being revalued to 30,000, then the revaluation is going to be 5,000. And then within buildings, well, we've got some brought forward accumulated depreciation of 10,000, and at this stage we can see that the carrying value at the beginning of the year must have been 50,000 minus 10,000, in other words 40,000. And then during the year we've had our we've had both, but let's do the revaluation first. We know from the revaluation note that we've just looked at that the value of the buildings must be a total of 50,000. It's 80,000 for buildings and land, 30,000 of which is for the land. So the remainder must mean that it's 50,000. Well, if that's the case, we will just eliminate all the depreciation to date. So we have a minus 10,000 there in the accumulated depreciation. And that took place at the beginning of the year. So during the year, these buildings have been depreciated, and we know that the depreciation rate that we apply is going to have to be based on the number of, or the remaining estimated useful life. So we've got 20 years remaining, so that gives us a depreciation of 2,500, or 2.5 million if you wanted, but I'm going to call it 2,500. So quickly totting those up, I can see that my carrying value at the end of the year is going to be 30,000 for land, 47,500 for buildings, and that I've got some depreciation that I can put into my, well, if you can remember, it's not cost of sales on this occasion, it's into the admin account. And then I can look at the dealing with the revaluation reserve. Now it's interesting, within the nature of this spreadsheet, you can't really automatically make two cells merge into one for your headings. So I just left mine, and it says revaluate T, but I'm sure that the marker will either be able to look at the cell itself and see that there's more in it, or just understand that that means revaluation surplus. There wasn't anything at the beginning of the year because we saw that from the trial balance. So the property's been revalued by 15,000, fine. 10,000 for the buildings, 5,000 for the land, and we know that at a 25% tax rate, then we're going to have to deduct that from the revaluation surplus and put that into the deferred tax account, leaving us with a carried down figure of 11,250 for the revaluation surplus. Now we can also put that 2,500 into the admin costs. I've got 3 columns here: cost of sales, distribution and admin, and I will start to accumulate those costs before I put them into the profit or loss. So we've dealt with the property, and we've dealt with the accumulated depreciation on the property, but we haven't dealt with the plants and equipment. Well, we've got the cost value, we've got the accumulated depreciation at the beginning of the year, so they can go in straight away, brought forward, and then because that gave us a brought forward value of 50,000, and we knew that we were depreciating by 20% on a reducing balance basis, then we're able to put the depreciation for the year in here, and that gives us a carrying value carried down. Sure enough, we're then able to put that 10,000 into cost of sales, because that's what this company's policy is, that we charge the depreciation of plant and equipment against cost of sales. So now I've ticked off quite a few of the points within the trial balance, and I've identified that I now want to cover the two that are at the top of my list, because perhaps the main reason being is I just don't want to miss them off. So in they go. I've got 56,000 for equity shares. I've got 1,400 for the retained earnings. Retained earnings is going to be one of my last calculations, because it will require me to be able to add the profit for the year. But we've got the beginnings there of what I could call a statement of changes in equity. Right, now we've got the tax aspects. The balance on the current tax represents an under or over provision. This isn't an unusual expression for the examiner to use. It's just so that he doesn't give away what it is at this stage. And that's the balance at the beginning of the year. The required provision for income tax at the year end is 19.4 million, which is fair enough. That's going to be something which is going to be our balance in our current liabilities. and we're going to have to do some calculations to find out how much is going to go into the profit or loss. In addition to the revaluation, there is a further difference between the carrying amounts of the net assets and the lower tax base at the 31st of March. So we know here that we must have because it's a lower tax base, we must have a deferred tax account which is going to be a liability, and the difference is 27 million. The tax rate is 25%. It isn't going to be too hard to figure out what our closing deferred tax is. So here we can go in straight away, and we know that the closing deferred tax is going to be 6,750. We were given the opening amount, and we were given the amount of revaluation. Well, we've already calculated the amount of revaluation, and with the current tax, again, we're taking this off the trial balance, but we've got the 800, and then we know that the 19,400 is the figure that the note has just told us is going to be going into the current liabilities. I think I've just skipped a page. So having done that, I can now work out that the deferred tax account needs to have an entry of 400. So in other words, we've increased the deferred tax by 400, and that's come from the current tax account. So here we've got the 400 as our balancing figure, as it were. We knew that the total had to be 6,750. We knew we'd brought forward 2,100, and we had a revaluation amount of 3,750. And if we added those up, we know that that is 400 short of the 6,750 that we would have to have as our closing balance. So we then are able to recognise that 400 has come from the current tax account. Again, the current tax account, yeah, we knew what the opening amount was, we knew what the closing amount was, and we also knew now that there was 400 of deferred tax that was being debited. So totting that up again, and we calculate that the profit or loss value is going to be 19,000. Next one, the inventory. Interesting one, this one. Inventory was not counted until the 4th of April. We clocked that. There was some operational reasons. At the date of its value, cost was 36 million. Well, that's helped us a little bit. Sure enough, it says 36 million in the trial balance, but it's reminding us. And this figure has been used in the cost of sales calculation above. Right. So the 36 million in cost of sales was deducted, wasn't it, if it was the closing balance? And that is a few days late, so we might need to change something in our cost of sales. Alright, between the year end on the 31st of March and the 4th of April, when the inventory was counted, Highwood received a delivery of goods at a cost of 2.7 million. Okay, so using our figures, that would be 2,700. And they made credit sales, okay, in this period of 7.8 million, and these were at a markup of 30%. So in other words, they were 130% of the cost. Neither the goods delivered nor the sales made in the period were included in Highwood's purchases as part of cost of sales. That's helpful. So the closing balance does include the additional items that have been purchased during the period, but that the purchases haven't been included. Okay, and the revenue doesn't include it either. So we've got to make some adjustments, but we don't need a lot. It's an interesting complication. So the inventory is recorded as 36,000, and we need to add on the value of the sales that took place after after the year end, but before the inventory was taken, because obviously those items would have been as part of inventory on the 31st of March, and we need to take off those items that we acquired through that delivery of 2,700, and the value there of 6,000 is the 7,800 divided by 1.3 to bring it down to its cost value. So we've now got an inventory value of 39,300, which is, as you can probably see, 3,300 more than we've recorded within our trial balance. And that means that we've got to increase the value of inventory, and we've also got to reduce the value of the cost of sales. So now we can complete the profit or loss, and here we have it. The revenue comes straight in. Cost of sales, of course, we've had to do those additional calculations for. Gross profit is worked out on the face of the account. Distribution expenses, there wasn't any changes there. The admin expenses, well, there was a figure from the trial balance, and then we added on the depreciation. Profit from operations comes up. There's no finance costs, so the profit before tax is the same as the profit from operations. Tax, well, we'd worked that out within our note. We've got the profit for the year. There was a revaluation. Sure, this is revaluation net of the deferred tax. So that's 11,250, giving us total comprehensive income of 57,750. I then updated my retained earnings, and sure, I've got a little statement of changes in equity. It isn't something that the examiner is going to give me any marks for, but it's enabling me to work these figures out. So I added on the profit for the year and my revised closing value, as it were, for retained earnings, 46,900. No dividends. And now we're going to complete the statement of financial position. And here we have it. The property, plant and equipment comes straight from the working that we did. We have those different, the land, the buildings, and the plant and equipment. The inventory, sure, we worked that out. That was the 36,000 that we added the 3,300 onto. Receivables, we haven't had a change, and we've got total assets of 203,900. The equity share capital, and in fact the whole of the equity section, was very easy for me because I was able to take it straight from my statement of changes of equity that I'd sort of drawn up. The deferred tax balance has come from that account. The loan has come from that first working when we had the to break down the convertible loan into the debt element and the other components of equity. The bank figure, yes, was just given to us within the trial balance. It was a credit value, so that told us it was an overdraft. And payables just come straight from the trial balance. And the current tax figure, well, we worked that out. Well, we were actually told, weren't we, that it was going to be 19,400, but we did do a little account on it. So we've got the statement of financial position where it balances. Now, what's the key to our success, I suppose, is that we've treated the whole of those two tasks as one question. Now, sure, they'd allocated 8 marks for one and 12 marks for the other, but we really allocated our time against 20 marks. In the first section, the revenue, which didn't require any calculations, earns you half a mark, so you might as well get it. The cost of sales, which did involve the calculations, is worth very good 3.5 marks. Distribution expenses, again a copying figure. Admin expenses, we had to add on the depreciation on the buildings, so that's why it's worth a mark. Income tax expense, we had to do the additional calculation, and similarly the other comprehensive income, where we were looking at the revaluation and the recognition that part of it was on the land, part of it was the buildings. Overall, 8 marks. Again, on the statement of financial position, property, plant and equipment, we did the note, but there was plenty going on. Now that got us 2.5 marks. Inventory, we'd had to make the adjustment. Trade receivables with a copying. Retained earnings, well, you would get the mark because it's the total of the opening retained earnings and whatever your profit for the year was. So I think that's important. It isn't because we got a particular value, it's because the approach we used was correct. Revaluation surplus, similar. Other components of equity, that was quite kind of them because that's come in from our loan note. So here you can see that we've got a mark for that, and we've got another 1.5 marks for the debt component. So you can see where these workings are really earning you a lot of marks. Deferred tax gets a whole mark, mainly because we've had to add in the aspect that's come in from the revaluation of the building, but also we've recognised that there's been an increase which has come about because we've got a difference, and so that's come from the current tax. Bank overdraft is a copying, as is the trade payables. Current tax payable, again, a little calculation. There's no marks for it balancing. There's no marks for even putting in those total equity and liabilities or total assets. So do bear that in mind, that it's these key figures that require the calculations that are going to earn you the marks. Okay, thank you for watching. If you are interested in attending classes with me, I tend to hold them in the South Coast, either at Brighton or at Arundel, and my email address is given there, as is my Facebook contact details. Thank you very much for watching, and yeah, by all means like this video if you like it, and subscribe to the Sandy Hood channel if you like. But thank you very much for watching. Goodbye.